I'm not going to go through these formulas. I go through this in my Finance 301 class. It's a creative way of using the VLOOKUP function. We also have price-book ratio. Sometimes we call it book to market, or market to book, I'm sorry. This is basically price per share divided by total equity per share. Because this total equity per share is also known as book value per share, or book value of equity. Also, this is market cap divided by book value of equity, which is a fancy term for total equity. The interpretation of this is what sort of a premium market attaches to the book value of the firm. Remember, when we list the assets, we list them at historical cost minus any accumulated depreciation. And there are certain assets that don't even appear in the books, like the brand name, unless they purchase the brand, or individuals that are important to the firm, like Steve Jobs, for example. Typically, the so-called growth firms or tech firms tend to have higher market-to-book ratios. The so-called value firms tend to have lower. So for Google, let's look at the market-to-book. Let's go to summary. Actually, we'll see it under statistics. Price to book, based on most recent quarter, 474. That means market attaches about 375% premium over and above the book value. Let's look at Amazon. $685. It's higher. But that may be because there are certain assets Amazon simply doesn't have in its book. For example, for Google, at a minimum, they have YouTube as an attached value in their assets because they acquired YouTube. A lot of Amazons are not acquisitions. They have an algorithm. That algorithm has no value in the books because it hasn't been purchased. So in general, don't trade based on those. There is another one called price to sales ratio, only used when firms have zero or negative earnings. Don't ever trade based on price to sales ratio. There's one more ratio we use somewhat. It's called PEG ratio. This does kind of a quick and dirty correction for growth differentials. This is basically PE ratio divided by expected growth rate. So for Amazon, it will be 99 divided by 46. For Google, it would be 21 divided by 15 and a half. So on that metric also, Google seems to be cheaper, but I would never use that for trading purposes. I mean, if you have a very big difference on PEG ratio, that kind of flags a potential trade. So a PEG ratio of 3 versus 1. That would immediately tell me, okay, I should look at this PEG. But 215 versus 135, I don't know. I need to see the details. It's a quick and dirty correction. This is not in the books, but another way to look at PE without the effect of leverage and non-cash items. It's called EV over EBITDA. It's short for enterprise value. Enterprise value divided by earnings before interest, taxes, and depreciation and amortizations. So that you could think of the firm as a business, but you also don't take the taxes and depreciation into account. At a minimum, you should correct for non-cash items. We talk more about these in our corporate finance class, and we have a class called Finance 410, Valuation and Financial Statement Analysis. But for this class, kind of know what they are, and most finance websites have those numbers. 2791 for Amazon, Google, $399. But of course, a lot of that has to do with growth to financials. Again, you can calculate growth adjusted versions of those, or you could simply do something similar to PEG. Take something like enterprise value over EBITDA divided by the growth rate. Okay, that's pretty much all I'm going to talk about. Ratios in terms of just understanding what they are. Let's give a 15-minute break, then we'll do many problems regarding these ratios. Let's continue, guys. Okay, who's going to tell me the answer for this? Market to book ratio of a leverage firm, which means a firm that has debt, compares the price per share of the stock to do what?
Total equity.
Total equity or book value per share, either one. Just a definition. A firm has a times interest earn ratio of 2. This means the firm has twice as much earnings before interest and taxes as it does. If you remember the definition. You can also name such as times interest earned. It's twice as much as the interest payments that they make. interest expense. According to DuPont identity, ROE is profit margin times 1 plus debt equity ratio. Right or wrong? That's false, because ROE is ROA times 1 plus debt equity ratio. You can compute the DuPont identity by using profit margin times 1 over capital intensity ratio times 1 plus debt equity ratio. Yes or no? Huh? I can't hear. I'm old, remember? I'm sorry, older. I don't consider old age start until 70. As far as I'm concerned, middle age starts at 55. DuPont is profit margin times TAT times 1 plus debt equity. But TAT is also 1 over capital intensity ratio. So the answer is indeed true. We talked about this in the last class. A firm has a current ratio of 1.2 and a quick ratio of 0.5. This indicates that firms buy inventory on credit. True or false? Let's think about it. This is actually an instructive question.